Greetings, Professor McKee here with the next episode of Seminar Saturdays. Today we'll be talking about how fraud is contagious. Today's paper is Fraud Contagious? Social Connections and the Looting of the COVID Relief Programs. This is by John Griffin, Samuel Kruger, and Prateek Mahajan. My apologies if I mangled any of their authors' names. And this was presented at AFA in 2025, so this is a non-published paper, still a working paper. And I was at the presentation. I was at AFA for this year, and this is a paper I saw. I was pretty interested in it. They also have several other papers where they're looking at detecting fraud in some of the COVID relief programs, so this is an extension on some previous work they've done in the past couple of years. So they reference that paper a lot, and if you're interested in more details, I will include the prior papers that have been published where these authors are looking at fraud and Paycheck Protection Program, as well as some of the other COVID era programs. So the question they're looking at specifically is if fraud is contagious, like a disease. Possibly, because people might be sharing information across networks on how to commit fraud. There is some previous recent papers that have found similar things like this. So Dimmock et al. In 2018, they're looking at financial advisors, and misconduct seems to spread across personal connections. And then O'Malley in 2023, there's healthcare fraud that seems to spread across networks too. And so if this is the case, generally, then this is a downside of networks, right? We can share information. Sometimes this is good. We share information that helps other people. Other times we share information about how to do bad things, like commit fraud. And so this is often the case with many things we find in finance and economics. Sometimes there are good things. Sometimes there are also bad consequences. So some background about what they're going to be talking about in this paper. There's two main COVID relief programs that they're looking at. The first one is called Economic Injury Disaster Loans, EIDL, E-I-D-L for short. And this is a program that existed before COVID, but it got changed a lot in response to it. So before COVID, it was a program that gave loans to businesses in areas that have had natural disasters. So you're a small business, hurricane sweeps through, knocks over, all of your infrastructure, a loan to help you survive this disaster. It was expanded in response to COVID, and these estimates are either from government estimates or from their previous papers. There was estimated $136 billion in potential fraud, 33% of the actual payments sent out. Seems like a lot. And then there was expansions to unemployment insurance. They don't use it that much in this paper, but there's also a lot of estimates of high amounts of fraud in those expansions too. And then the Paycheck Protection Program, this was a new program which gave forgivable loans to small businesses. So it's pretty similar to the EIDL program as well, except it's a new program. And a prior paper by these authors estimated that there was 15% of the amount sent out, or 117 billion, in potential fraud. Now, their PPP data is very good. It's at the loan level, so they have a lot of information about each individual PPP loan. The Small Business Administration that administered the program, they also administer EIDL, issued this information. So they use all loans that were issued starting in April 2020 through June 2021. So about most of 2020, half of 2021, and those loans that were not repaid or canceled by the beginning of 2022. And so they have almost 11.5 million loans and almost $800 billion in total amount, adding up all the loan amounts. And they don't go into too much detail about how they're detecting these potentially fraudulent loans, which would also be an interesting paper to go over. That's from their 2023 paper that they've already published. But some of the things that they used in that paper and that they're using here, again, because they're using that same PPP data, is if the loan was to a non-registered business, if there were multiple loans to the same residential address, kind of suspicious that there isn't an actual business that they know about, and that there's multiple businesses operating out of the same house. If there's a high implied compensation relative to industry averages, remember the whole point of the PPP was to protect paychecks, keep the employees employed. And so I think there's information in the loan level data saying that would help you imply what the salaries are for all of your employees. Well, if you have really high salaries versus the industry average, maybe you're lying about those salaries. And then inconsistencies between the number of employees in an PPP application and the idle application by the same company. So they know it's the same person, same company that's applying for both PPP and idle, and they say different things about their number of employees. Kind of suspicious. When they look at idle and unemployment, their data is not as good. They have much less individual per loan data than with the Paycheck Protection Program. So they do have some things with idle indicators. A lot of the same things they use to detect fraud or potential fraud in PPP is also used for idle. One addition is that for idle, apparently you could get an advance up to $10,000 before actually getting a loan. And then if you get the advance and don't actually get the loan, what's happening with that free $10,000 you got, which was supposed to be an advance on the loan itself? And then they have county unemployment claims per month for 33 of the 50 states, which is something they'll be using. Now, how do they look at social connections? So what they're doing is they're following a couple papers by Bailey et al., one in 2018, one in 2020, and they're using social connections combining geography and Facebook. So they take pairs of zip codes and they see how many Facebook connections there are between people who live in those zip code pairs. So if I live in a zip code and you live in a zip code and we're Facebook friends, that's a connection between our two zip codes. The more connections two zip codes have, the more socially connected the people in those zip codes are. And so they're using geographical proximity and social media proximity to see how connected two zip codes are. And they have lots of additional data as well. There's more than just what I am mentioning here, but they have all sorts of demographic data at the zip code or county level from U.S. government. They have a lot of county level variables. There's some previous papers, which I'll mention a couple of them and have some of them in the video description. There's some suspicious activity reports involving some financial agencies, so FTC and FinCEN. There's county level data on how small businesses are doing. Google search data, social media activity in groups. And that's going to be a key one that they're using. Okay, so that's all the data. This is a big paper with a lot of different data sets all being brought together. And one thing I found interesting when I saw this paper presented was how the fraud was distributed, because there's very clearly some patterns with the distributions here. The darker the county is, the more likely a given loan in that issued to a person in that county is going to be flagged as suspicious. So this is scaled by number of loans to county, and then how many of those loans are looking suspicious. So there are some urban areas that are very, very dark looking because they have a lot of these suspicious loans, and you kind of see it's concentrated in urban counties. It's concentrated in the suburban counties surrounding those urban counties. And even within a single county, there's a lot of variation on the zip code level. So they look at the county, and then they look at how many loans are flagged within a zip code that's inside that county, because zip codes are effectively a smaller geographic area than the entire county. This is really useful for them because they can get nice heterogeneity within counties. They can compare zip codes within the same county, and that controls for a lot of similar things that we might think could affect rates of fraud. So for instance, if you have a county with a really high percentage flagged, 30%, like 31% here it looks like, you could have zip codes within that county that have extremely low amounts of loans being flagged, or more than 50% of the loans are flagged as suspicious. So there's a lot of variation in these high suspicious loan counties when you look at individual zip codes. So, were areas with high suspicious PPP loans also high in likely fraud from the other sources? And the answer to that is yes. If you had a zip code and you had high suspicious PPP rates, you also had high suspicious idle rates. And if you had high excess unemployment claims in a county, that county also had high suspicious PPP loans. So it wasn't something specific just to the single program. There was suspicious activity going on in all sorts of related programs too that would have slightly different rules. So it's not like there's something specific about PPP that attracts fraud. It was just going on everywhere. Then, does social proximity increase the chances that we have high amounts of flagged PPP loans? Yes. So here they're looking at flagged loans per capita in a zip code, and if that zip code is proximate to other zip codes with high rates of flagged loans, they also see more flagged loans. Now, if you instead look at physical proximity, so your zip code is nearby to another zip code with high suspicious lending, it looks like you also see it, but if you combine these two together, only the social proximity survives. So it doesn't seem like this, at least this is how the authors interpret it, is that it's not being driven by I live in a zip code close to a different zip code where people are doing lots of fraud. It's I have a social connection to a zip code, and that zip code could be far away or it could be close. How physically near doesn't actually matter. Now they try to do an instrumental variable here, which is pretty much their only way to really get at causality. There's a lot of correlations that they find that are very interesting. So they use social connections to distant zip codes that are very far away, 100 miles, 500 miles away, and that's their instrument that they're using. If I haven't discussed instrumental variables before, that is one technique, that econometric technique we can use to try and find causality. It's more technical and often less interesting to talk about than some of the natural experiments, but it is a technique people will sometimes use. And they again find the same thing. So social proximity is going to be resulting in more suspicious lending. It's also not the demographics of those individual zip codes that are causing it. It's the proximity to suspicious lending. Demographic proximity disappears once you control for the social network. They then look at some cultural characteristics. So perhaps, because this is one potential problem we always have with social network research, is people become friends because they are similar to each other. There's a fancy word the paper uses. I'm not going to use it because I can't pronounce it. But two similar cultural characteristics explain why both there is high social proximity, and it explains the increase in suspicious activity. The answer seems to be probably not. They have a whole bunch of different measures. So how much identity theft previously went on, how much identity theft was going on at the same time, suspicious activity reports, public corruption, religious affiliation, the usage of a popular cheating website. And most of these things don't show up after you include the social proximity for suspicious lending. And another thing to note here is our social connections has a very high magnitude, 0.529. Identity theft is the closest, which is about half the size. Religious affiliation, for some reason, is showing up here too. I think there's an explanation for that, which we'll see in just a minute, but it's only 0.08. So there's a very small increase in flagged loans if you have more people that are religiously affiliated versus if you had high social proximity to other zip codes or counties. In this case, it's counties with high amounts of PPP flagged loans. Right, so this survives all these potential cultural characteristics, and it's much stronger in terms of economic importance than the other variables too. Now, one thing they do look at is something called social capital. This is from a couple of papers by Chetty et al. In 2022, and those papers were finding that if you're connected, you have social connections, because of social capital, you get more social mobility, you get more economic mobility. If you have more social capital in your neighborhood growing up, you perform better on various quantitative metrics after you become an adult and start working. So that's an example of social connections benefiting people. And so they say, well, we're finding some downsides here. Maybe that social capital spreads fraud as well as improving social and economic mobility. Maybe, but it's really more just the social proximity to actual fraud. So all these measures here are things that the Chetty paper was finding results in better performance for people who are in those areas later on in life. So connectedness economically, exposure, friending bias, clustering, support ratio, volunteering rate. A lot of these don't really survive well once we include social proximity. So clustering is around civic organizations, maybe exposure or economic connectedness. One thing I noted in the previous table was that religious affiliation, if you had a higher rate of adherence to any religious organization, well, churches count as civic organizations, I assume. I haven't read Chetty's paper super carefully. And so if you have more churches, you probably have more religious affiliated people. So I'm not sure which one is driving this. But those two are very likely connected. And again, you see all these magnitudes. We have 0.04, 0.07, 0.1. Meanwhile, social proximity to suspicious lending in other zip codes, 1. It's an order of magnitude bigger than all these coefficients here. So again, suspicious social connections is much more important than these other social capital measures, although some of them seem like they might actually be spreading this PPP fraud as well. Now, one thing they show here is the timing of the fraud. So if fraud is being spread over social connections, we should see it increase over time. Over time, people should start realizing, oh yeah, my friend was doing this PPP thing and he got free money. I should try it too. And so what they see is that over time, you can see a kind of an increase in the percentage of loans that are being flagged, and there's a big jump where the ones that are connected to the high zip codes, that's the line in red, are way higher than the ones that are matched to low social connection zip codes. So the ones with low social connections to fraudulent areas did not see nearly as big of an increase. So yeah, nice confirmation there. And in terms of how the loans spread, so one of the things that their previous papers were looking at was the source of these fraudulent loans, and what they say is it's combination finance tech companies were the ones that were facilitating a lot of these fraudulent loans. If you went to a traditional bank to apply for your PPP loan, didn't really show it very much. So you have social proximity to lending that was suspicious in the previous year, where they're looking at 2021 loans, and then they're able to use 2020 loans as a variable. For all loans, if you're physically proximate, it actually reduces it slightly. But really, if you had a lot of fraudulent loans in the last year, you're going to have a lot of fraudulent loans this year. No surprise there. But if you have a social connection to a lot of fraudulent loans in the previous year, you also have an increase. And it's actually a bigger increase than just the historical data from the previous year. And this is all coming from fintech, right? The base level of fraud is pretty stable regardless of your source, but the social connections is showing up for fintech originated loans. But if you applied for your loan through a traditional bank, no, it's just based on the sort of the base rate of fraud going on in your county or zip code. Okay, so they next try to look at how the information spread through social connections. So remember, everything they're looking at is at the county and zip code level. So they're not really able to directly see people sharing information about how to do fraud. After all, fraud's a crime. Often people aren't going to just openly admit that they're telling people how to commit crimes. But of course, if they have social connections through Facebook, a major social media net platform, that's probably where we would want to look first, because we know these guys are connected through Facebook, so they're probably talking on Facebook. And so what they actually did, and I'm surprised they got so many matches, is they take a bunch of social media groups that are discussing PPP, IDLE, these various COVID programs, and they match the names on those groups to the names on the loan applications replying for PPP, and they get a lot of matches. They have 17,000, 14% of the users in these groups get matched to actual loans. I'm really surprised they are able to match so many people. Now, part of the reason this works is because they're using Facebook and everyone has their own personal name on Facebook, but just I've done name matching myself in other contexts. It's hard to match names well. And the data is usually quite messy and difficult to work with, so that they were able to get such a high percentage, in my view, is pretty impressive. And so they have the top groups here are the groups that had a lot of flagged loans. So a percentage that was flagged in each group, and there's a lot. And these bottom groups are groups that had low percentages of loans being flagged. And then their word cloud here, the right side is the people with high percentages of flagged loans, and the left side is the groups with low percentages of flagged loans. So this is not actually super rigorous in terms of causality, but it's kind of interesting to see how different these word clouds are. Also, there's Blue Acorn, Womply. Those are two fintech platforms that they had previously identified in their earlier papers as being major vectors for fraudulent applications. So they're colored in blue to indicate that they're not actually suspicious, but in reality they are looking kind of suspicious, and those guys don't get mentioned at all in the left social media group. So they think there's more suspicious sort of discussion going on in the right groups, and those groups, turns out they have more suspicious loan applications than the lower group. Now, all they had, as far as I can tell, is just those figures. I couldn't find any table that shows if matched users from suspicious groups more often had suspicious PPP loans. Now, it's possible I just missed it. This is a very long paper, 100 pages. There's a huge appendix with all sorts of tables that I'm not going to be showing. And maybe one of those tables does have this, but it feels like this is a very obvious thing they'd want to do if they haven't already done it, and maybe they didn't find anything, that's why they didn't include it. But if you're a matched user from these suspicious groups, are you more likely to have these suspicious loans? As in the groups that have the more suspicious kind of words, does that user, and you're a user in that group, are you more likely to have suspicious loans? But again, maybe they did and I just missed it, or maybe they haven't done it or haven't thought of doing it yet. Next, they look at the types of lenders that people are using based on their social proximity. So if you're a PPP borrower, you're more likely to use platforms that you have social proximity to. But this is only true for the fintech ones. So if you have social proximity and you're talking about Bank of America or JP Morgan, some traditional banks, you're not more likely to use these guys. But if you're talking about fintech, your social proximity means you're more likely to use them. You're more likely to use Womply if people you're connected to are talking about Womply, Blue Acorn, fintech in general. And again, remember, Blue Acorn and Womply were major vectors for fraud. So this is kind of supporting the story that fraud is going on. It is spreading through these social proximities, and then people are going on Womply and Blue Acorn and using their platform to submit these suspicious PPP applications. They also look a little bit at the idle loans. Again, the paper mostly focuses on Paycheck Protection Program because that's where their data is. But idle does have a requirement for applicants to list anyone who assisted them in the application process. So if there's an agent that helps you do the application. And they got this information, so they know all the agents are, and they find some interesting things there too. So panel A here, this is the graph here. The blue line is the actual distribution of agent flag rates, so how many loans this agent helped with that got flagged as suspicious. On average, you should have these dark lines. What actually happened is there's a lot more area under the curve out on the right side, which means there are a bunch of agents that are really very likely to be involved in suspicious idle activity, more so than some other agents. Not super surprising. So that there's agents that specialize in the fraudulent applications. And then if you look at panel B, your past flag rate, if you're an agent, so if a loan was previously flagged, you're much more likely to be involved in future suspicious flagged loans going forward. And this is overall, if you look inside within a zip code, it's even more tightly, there's an even tighter connection. So there's pretty good evidence, I think, that they're finding some agents that are very frequently involved in suspicious lending for these idle loans. Okay, so that is some of the paper. Again, it's a very long paper. It's over 100 pages with all the appendices and tables and figures. So I had to cut out a lot to try and keep it to a reasonable length for this seminar Saturday. What they seem to find is that there are indeed social connections that are connected to the spread of fraud. And they have a hard time here, I think, because they don't really have a good exogenous shock, so they can show that the social connection causes fraud. They can show correlations, and they do a good job showing a lot of correlations. And they try to rule out a lot of the common problems with the social network or fraud that might result in us thinking that it's not the social network causing fraud. But they can't completely fix that. I think that's probably the biggest challenge for them when they try to publish this paper is like, where's the causality? Because that's always the huge challenge for any empirical paper in our field. But it's interesting, but it's still a very interesting paper to read about. All those correlations are quite interesting. It's a very, very novel sort of type paper too. You don't usually see a lot of papers involving fraud like this. And it's a good example of potential downsides for social connections. And I've talked about social connections in several papers in the past for this semester. We can share information across social networks, we can share bad information as well as good information. And so that is our paper for this week. And next week I'll be working on bringing you another paper from AFA.